Hello everyone, welcome to today's video. In today's video, we will be discussing about the federal policy rates decision which are recently taken by the within the US economy by the US Central Bank, right? So this US Central Bank is called as Federal Reserve, right? And what all decisions are taken by this Federal Reserve are directly and indirectly responsible for the global economy, right? So we will discuss like what all these policy rates are and how it will impact the global economy along with the US economy, right? So these federal policy rates are called as federal funds rates, right? So every country is having their particular naming system for everything, right? So in the same way, the interest rates in the India are called as interest rate or repo rate, right? So in the same manner in the US, these policy rates are called as federal fund rates, right? So let's see in the next slides what all the things are there in this federal funds rate one by one, right? So these federal funds rate are sort of interest rate within the United States, right? And these federal fund rates are decided by FOMC, which is a crucial committee in the Federal Reserve, right? So this FOMC, which is called as Federal Open Market Committee, is responsible for giving the suggesting these interest rates or the federal funds rates to the Federal Reserve, right? So now in this slide we will discuss what exactly is the difference between MPC, which is sort of a committee who decides the interest rate within the India, and the FOMC, which decides the interest rates within the US, right? So with this slide we can understand what exactly is the difference between two committees and like how the exact things happen in both the countries, right? So as we already discussed, FOMC is called as Federal Open Market Committee, right? So this Federal Open Market Committee announces the federal fund rate, right? FFR we will call it, right? Sorry. So and the first thing which happens here is like they gives you the rates in the form of range, right? Like the old rates were from the range of 0 to 0.25 percentage, and now they are in the range of 0.25 to 0.50 percentage, right? But in the contrary manner, in the India, the rates given by this monetary policy committee are given in the form of fixed rates, right? So fixed rates are like 2%, 4%, something like that. In India, there is not the range of the rates, right? So that is a crucial difference between these both rates, right? And in India, the rates are like any one important rate is declared and other rates are given in proportional to that rate, right? Like if the repo rate is declared, then reverse repo will be in one relation to that and something like that, right? So most of the times this relation is accurate, but sometimes the monetary policy committee and RBI decides or declares all these rates individually as well, right? Then the future projection for this rate is up to 1.75 percentage, right? Now the main reason to have that high interest rate is inflation. Now inflation is like from the recent data and or from last two seasons, sorry, the years of COVID has impacted the US economy and the global economy through so many tough situations, right? So that's why the inflation is at the 40 years high records, right? So that's why in the future days it is expected that the interest rate of US reserve will be up to 1.75 percent, right? And the last difference between these two committees is like the FOMC meet 8 times per year, right? Which is approximate after every 45 days, right? And in the monetary policy committee meets only 4 times a year, right? Which is after every quarter, right? Like every year has 4 quarter, right? So after each quarter they declare the policy rates, right? Now the main reason like how this policy rate like FFR, federal fund sorry federal fund rates or the interest rates, how these rates impact the economy we will discuss through this slide, right? So bank, so like we, as you already know, bank do multiple operations, right? Like they give loans to the individual and to the other banks as well, right? So when the bank lends the money to the other banks for overnight purposes, that operation is called as call money, right? So in the call money, bank gives the loan to other banks only for the 24 hours window, right? So this is one of the crucial operations of in the banking, right? Because banks are already like all the time having the crunch of money because they need to handle with so many customers, right? So like when the federal fund rates or any banks like policy rates changes, then it directly impacts this call money operations as well, because right, because if federal fund rates are increased, then call money operations rates will also increase, right? So if the rates are increased, then the lending will be decreased, right? Because like if the rates are increased, then other banks will think before taking any extra loans or unnecessary loans, right? So that's why if the just wait, we'll have all these things in a one row. If the federal fund rates are increased, then call money operations will decrease, right? Sorry, will decrease, and this will decrease because not every bank can, not every bank can afford to take the continuous loan as like before, right? Because like every bank is having the different financial condition, right? Like some banks are having high NPAs and other issues, right? So that's why if the federal fund rates are increased, it will impact the call money operations and other important lending operations or borrowing operations of the bank, right? Now like as we already discussed, what will be the other issues which will be there after the rate changes, right? So now all the lending operations will be readjusted, right? Because like all the rates like the loan rates and all the bond market and all things, they'll have some particular rates before the declaration of the bank, right? So now all these rates will be sorry so now all these rates will be adjusted, right? And federal rates increase, so so all the bank so all the bank rates will also be increased, right? So there will be there will be the situation of high interest rate at everything, right? So if there is high interest rate, then obviously like no none of any other banks or any private institution or any individual will take any unnecessary loans, right? So if any person or institution is having less money within them or within their institution or within their pocket, then there will be less money within that institution, or which means ultimately there will be less money within the economy, right? So that's why like once there is less circulation of money within the economy, so it will help to reduce the inflation, right? Because the prices won't rise because everyone will be having less money with them in that condition, right? So in some way, when the policy rates are FFR or something like that, when the policy rates are high, then inflation is low. Now, in all conditions, this cannot be true, but in most of the situations, this happens. So, the main condition of increasing the policy rates is to curb the inflation in most of the economy or the situations, right? So now, now we will see the impact of interest rates. So now the lending rates in the US will increase, right? So similar to lending and borrowing rates of the bond market in the US also increase, right? Because like these rates will be interconnected to all the other lending operations as well, right? So that's why the bond market rates will also increase. Now if the bond market rates are increased within the US, then all the company which have all the companies or foreign investors who have invested in other economies will take out their money from that economies, because they'll be getting lower return on investment from those economies, and they'll invest into the economies where they'll get the high interest rate, right? So they'll take the money back from that economies to the economies where they will get the maximum output of their investment, right? So all the foreign investors will take the money out of India or all the other economies, and they'll invest all that money into the US bond market, right? Because they everyone wants the high interest rate on their investment, right? So in those situations, like if the federal reserve is increasing their uh, rates, so in that manner it is good news for US economy, but that is a bad news for the global economy, right? So from this point we can understand how it impacts the US economy or the global economy, right? Then there is one other another interest, like the rate which is sort of similar to the FFR, which we have said as federal fund rate, right? So that is called as effective federal fund rate, right? So this effective federal fund rate is nothing but the weighted average of all the lending rate, right? Because we can take like car loan or home loan or something like that, like all the multiple loans. So there is a weighted average of all these loans, and that weighted average is called as effective federal fund rate, right? So if any economies uh, like condition of like improving or worsening has to be dealt or analyzed, then this effective fund rate is analyzed, and it will give the clear indication of that economy's growth or like worse condition, right? So there is not any particular difference between a federal fund rate and effective federal fund rate. It is just a weighted average, right? So yes, that is it for now. See you in the next video. Thank you.